So welcome, especially to the guests from our international guests, the guests that rushed from the GPFI plenary in the Kruger Park to join us. I'm hoping you saw some of our four-legged compatriots in the Kruger National Park while you were there. If you didn't, please come back and spend some time there. The launch of FinScope is an annual event on our calendar where we take stock of progress that we've made in the country around financial inclusion, financial and more economic inclusion in the countries for consumer and small businesses. It provides data and evidence for regulators, policymakers, private sector companies, and civil society organizations to develop their strategies, their products, and their policies. The FinScope, by the way, is funded by a combination of the private sector and public sector regulators, which is an important public-private partnership that has sustained FinScope for the last, I think it's 23 years now we've been conducting FinScope. While I say that and look at David Porteous, I'm reminded that we are honored to have him with us this evening as the founding member of Finmark Trust, as well as a founding member of FinScope. Him and his peers developed the first FinScope 23 years ago. David, welcome. It's an honor to have you here. I hope you can see that we haven't squandered what you've started. We've grown it, we've added value to it, and we've kept it relevant, not only in South Africa, but in 35 countries around the world. So welcome, David. Of course, David is now gone way beyond us. I don't know, what do they call you, the godfather of financial inclusion globally, David? I'm embarrassing him now. I think the FinScope and the results and the evidence that we generate for especially policy making, we've taken it for granted that policy needs to be developed on the basis of evidence. But I think we've seen recent developments around the world where powerful companies and people forget about facts, forget about evidence, and develop policies that affect not only their own people, but people around the world on the basis of personal whims and personal preferences. It's something that I don't think we should be taking for granted. It's a very dangerous process. And in South Africa, I'm hoping we don't go down this road and we keep making evidence-based policy. One of the examples, just one of the examples, I just need to get this off my chest, for South Africans, is a view that there's a genocide in South Africa happening, with white farmers are being exterminated. And of course, the same voices, amplified through social media, of course, ignore real genocide that's happening in parts of the world, including on this continent. So we shouldn't take this evidence for granted, and I'm hoping we return quite quickly to evidence-based policy in the world. Finmark Trust and the FSD network have been debating financial inclusion over the last 4 or 5 years. And the debate was sparked by an inconsistency of increased financial inclusion and decreasing food security and general well-being. And we coined a phrase that is taking us to the next iteration of financial inclusion, what we called Financial Inclusion 2.0. You will see from the FinScope results that we will present today a bigger emphasis on understanding how people live, how people earn their living, how they survive, and what role financial services plays in that process. And a much stronger demand-side approach to it, so that any financial inclusion or financial access interventions need to be measured on the basis of what benefit they have to ordinary people. I've said this before, I think financial inclusion is in danger of losing its place that we fought, and David and them were the pioneers, fought hard to move it up the policy agenda if we don't demonstrate the impact and the role that it plays in addressing poverty and inequality. You'll see it coming through. You'll see a bigger emphasis on looking at the informal sector, given that most of our economies on this continent are informal. Understanding the informal sector, who are they? Who are these informal workers? How do they earn their livings? A bigger emphasis on basic needs, a bigger emphasis on risks such as climate change, and what role the financial sector can play in these areas. The process we're involved, we haven't arrived at developing the most appropriate measurement frameworks yet for financial inclusion 2.0, but we are on that journey, and the debates that we're having with ourselves and with our partners is taking us in that direction. I think that's going to reestablish the important role that financial inclusion plays. So I got that off my chest. That's all from me. I am going to introduce now the first speaker, Jayashree Venkatesan. I hope I got that right. She's Senior Director, Consumer Protection from the Center of Financial Inclusion. She's going to give us some opening remarks. Jayashree, please join me.
Thank you, Brendan. I'm delighted to be here, and I'm delighted at Finmark Trust's partnership at the Responsible Finance Forum. I can't think of a better way to open this forum. And like Brendan said, I lead our research at the Center for Financial Inclusion on consumer protection. I also lead our strategic industry engagements. And a big part of our strategic industry engagement portfolio is the Responsible Finance Forum. So, it's a big deal for me. It's an annual convening that feels more like less like a conference, more like a reunion of friends, of extended family almost, people who share a deep commitment to solve the problems that inclusive finance faces today. And it's a highlight of my year. So I'm really grateful for all of you to be here as well. As a quick background, the Center for Financial Inclusion is an independent think tank which is housed within Axion, and we're a global nonprofit on a mission to create a fair and inclusive economy. As a think tank, we conduct research, we pilot innovative solutions, and we convene the inclusive finance sector to spark evidence-based change. And RFF is one of those convenings. The other one is Financial Inclusion Week. And we have been convening RFF since 2023 in this format. But I have to say that we didn't create RFF. It was first conceptualized as a community of practice in 2009 by BMZ and GIZ, CGAP, IFC, and the Netherlands Ministry of Finance in partnership with the wider G20 GPFI community. And it was originally convened by IFC between 2009 and 2022 with the intent to foster collaboration between the private sector, policymakers, regulators, academics, donors, and consumer organizations. We've maintained that core objective and continue to build and expand the community and the partnerships that are core to RFF's existence in response to the increasing complexity of the inclusive finance landscape today, something that Brendan, you alluded to. And it's one that demands an approach that facilitates analysis, action, and collaboration to achieve responsible consumer outcomes. I have to say that RFF is a really unique gathering in the sector because it brings together these different stakeholder groups. And it's really important because we cannot achieve responsible finance working in silos. This requires collaboration across stakeholder groups, across regions, across problems, and we have to come up with collective solutions. So I would invite you to approach this forum not just as a conference, but as a working space for shared problems, for solutions, and to build deep networks, and to continue to identify allies as we work towards this collective goal of improving people's lives through the use of well-designed and well-delivered financial services. We're thrilled this year that RFF is being organized alongside the second plenary meeting of the G20 GPFI meetings. And we're very grateful to the National Treasury, to the Ministry of Finance, to the Financial Services Conduct Authority, and to the South African Reserve Bank, and all our other partners locally. We cannot have a meaningful discussion about responsible finance without the evidence to support areas that we need to work on together and to collectively measure our progress. So I can't think of a better way to open this event than with a presentation of the FinScope South Africa Consumer Survey 2024 results. So on that note, thank you and welcome.
Thank you, Jayashree, and thank you for allowing us to hitch the FinScope wagon to RFF this year. We'll see whether we can do it next year hopefully in the US as well. Good, thank you. Next up is Nontobeko Lubisi from National Treasury, Director of Financial Inclusion. I think Nontobeko is becoming the face of financial inclusion in South Africa. Thank you.
I don't want to move the mics, but I need the iPad. Is it fine? I'm just fine. Good evening, ladies and gentlemen. The Chief Executive Officer, Mr. Brendan Pierce, and his team at Finmark Trust, colleagues at the Center for Financial Inclusion at Action, co-chairs of the G20 Global Partnership for Financial Inclusion, Ms. Magda Bianco from Italy and Mr. Chanchal Saka from India, delegates from the G20 Global Partnership for Financial Inclusion Work Group joining us this evening, FinScope Consumer Survey Syndicate members, partners, and friends, ladies and gentlemen, all protocol observed. Program Director, let me begin by saying that I am honored to be delivering this keynote address on behalf of the Acting Deputy Director General, Tax and Financial Sector Policy at the National Treasury, Mr. Christopher Axelsen. Unfortunately, he could not join us here tonight on this first evening of the Responsible Finance Forum, which is an official side event for South Africa's second G20 Global Partnership for Financial Inclusion's plenary meeting. It is also fulfilling to be here to congratulate Finmark Trust on 20 years of careful and successful planning of FinScope surveys. Mr. Pierce, your ability to adapt to unexpected delays or problems such as those we encountered during the coronavirus pandemic, when we had to put the survey on hold, is admirable and deserving of this recognition. Lastly, Program Director, I am proud, not just because South Africa is the first African country to host the G20, but also because we are halfway through our term and have received nothing but excellent feedback from G20 member states on our warm hospitality and the beauty of our land. Esteemed guests, despite the progress made globally, 1.5 billion adults around the world remain unbanked, with many more on the financial system's periphery. This is not because they just lack bank accounts, but because those accounts do not serve them in ways that foster resilience or unleash opportunity. So these are just not numbers. They are rural residents, informal workers, women, the youth, the elderly, and they collectively represent lost potential, untapped markets, and the voices of the underserved. Disaggregated data broken down by variable components such as income, location, disability, and so on is very critical for identifying disparities and informing targeting financial inclusion strategies. However, collecting disaggregated data comes with several challenges, and one of them is around data availability and coverage. Those that are underrepresented and marginalized that we want to track are frequently excluded from standard data collection efforts. Secondly, financial constraints. Collecting high-quality disaggregated data is resource-intensive, and budgets are often insufficient. In South Africa, for example, we are seeing this with the FinScope Small Business Survey, which still requires a defined model and commitment to funding from possible partners. There's also an issue of political and institutional barriers. Some institutions resist disaggregation that exposes inequality or marginalization. And this is especially critical because in South Africa, we have been attempting to restructure South Africa's economy and ownership patterns in the financial sector since 2004. And we are still not making much progress. However, fortunately for the country, FinMac Trust syndication strategy has effectively addressed these challenges because syndication of funding plays a vital role in enabling large-scale projects and investments that may be too risky or capital-intensive. By pooling resources from multiple funders or financial institutions, syndication also spreads financial risk, enhances creditworthiness, and boosts overall funding capacity. FinMac Trust established the syndication funding model in 2003 as part of its demand-side financial survey, and it has been a success to date. This collaborative approach does not only promote and build investor confidence, but it also allows for the diversification of expertise and perspectives, leading to better decision-making and improved project outcome, especially when syndicate members are part of the steering committee. Additionally, let me highlight that beyond funding, the value of syndication lies in its recognition of distinct roles. For instance, with FinMac Trust, we have the public sector, which is government syndicate members, who drive policy and regulation. We then have the financial service providers, who are mostly responsible for innovation and product design. And then we also then have development sectors and partners, such as FinMac Trust, who act as a catalyst that bring these elements together. This integrated approach ensures a cohesive and sustainable pathway towards broader financial inclusion and development. To Kingston, Jabu, and Abel, we acknowledge that managing this survey requires a balancing act. From fostering collaboration with us as members through consistent communication and feedback, to sharpening your analytical skills by navigating data for impactful storytelling. As syndicate members, we stay confident in the quality of your work because we are fully involved in the preparation of the survey questions, which then reflect our most essential priorities as policymakers. Ladies and gentlemen, the public sector lays the foundation by establishing an enabling regulatory environment, investing in financial infrastructure, and implementing policies that promote access to financial services for underserved populations. The private sector drives innovation, efficiency, and scalability through the development of diverse financial products and digital platforms tailored to the needs of low-income individuals and small businesses. Meanwhile, the development sector, including our non-governmental organizations and international organizations, serves as a bridge by providing technical assistance, funding, and research support to ensure inclusive financial systems. Together, all these sectors form a dynamic ecosystem capable of expanding access to individuals, as well as making sure that we have sustainable financial services that will empower individuals, foster entrepreneurship, and drive economic growth. Let us recall the words of former President of the United States, Mr. Barack Obama, who once remarked, "Change will not come if we wait for some other person or some other time. We are the ones we've been waiting for. We are the change that we seek." Indeed, ladies and gentlemen, by engaging in dialogue, we can identify regulatory barriers and work together to create an environment conducive to inclusive financial practices. Our work on South Africa's National Financial Inclusion Strategy has demonstrated that coordination is more than just a concept, it is a commitment. Governance structures have been established to oversee the development of the strategy. These range from a council of regulators, which is pitched at Director General and Chief Executive Officer level from government departments and the regulators. There is a financial inclusion forum, which consists of private sector stakeholders, as well as technical groups that then connect the banks, fintechs, regulators, researchers, and civil society in one room. Furthermore, the collaborative effort under the Financial Sector Development and Reform Program, which is funded by the Swiss State Secretariat for Economic Affairs and managed by the World Bank, has provided us with technical expertise and convened key talks across government and the financial sector, laying the groundwork for long-term reform. We've been using these structures to make the strategy more realistic, inclusive, grounded, and representative of the daily experience of the communities that we serve. We can change the perception that financial inclusion is simply just about empowerment. through this platform, because financial inclusion is not charity. Rather, it catalyzes and supports industrialization by facilitating cross-border transfers and increasing the deposit base for financing low-income individuals and businesses. Mobile banking, digital platforms, and fintech solutions are breaking down all barriers, further proving that there is a positive association between financial inclusion and the sophistication of a country's ICT sector. In closing, I'd like to say, Africa has a long way to go in terms of implementing and expanding data-driven initiatives that give deeper insights and promote innovative financial solutions that are customized to the needs of marginalized communities. The challenge we face requires a new generation of leaders. Just in this room today, we are a microcosm of a pure breed of leadership. To realize the full potential of financial inclusion and ensure that no one is left behind, it is crucial that all stakeholders work together, and especially those who are still not funding and would like to be funding certain components of the work that we do. By contributing resources and expertise, you can play a pivotal role in strengthening the financial ecosystem, helping to expand access, enhance inclusion, and foster sustainable economic growth. Together, we can build a more equitable financial landscape that empowers individuals, drives systemic change, and unlocks opportunities for all. I leave you with a well-known quotation by a sagely individual from centuries gone by. And it goes like, "The task is laid out for you. You are not obligated to complete the work, but neither are you free to desist from it." All said and done, ladies and gentlemen, financial inclusion is not impossible. It is in our hands. Thank you.
Thank you, Nontobeko. You've made the FinScope team smile. I saw them smiling there. And I hope you remember those words when we want to increase your contribution next year for 2026. Ladies and gentlemen, this is what you've been waiting for now, the presentation of the results. My colleague Jabulani Kumalo, Senior Information and Research Specialist in the, what we call the FinScope team, is going to present. Jabulani, please come up. What you should know about Jabulani, when you look at that smart suit that he's wearing, is that he buys a new suit every year for the FinScope launch. That's why he looks so sharp. Thanks, Mfundisi.
Thank you. Thank you, Chief. Let me make a disclaimer. I was trained and mentored by the late Pastor Maholwan, and he usually told me that when I'm asked to come forth and collect offerings, of which I'm not going to do, I must do exactly that. So I promise I'm not going to preach, but we are going to deliver the results of FinScope 2024. I guess we are ready. Good evening, ladies and gentlemen. Mategwana Buti, Molweni, Koye and. Let's just go straight now to our content. This report serves as a foundational step towards advancing financial inclusion 2.0, as Brendan mentioned, emphasizing the meaningful use and effective use of financial services. We will therefore start by looking at the research objectives, the levels and drivers of financial inclusion, socio-economic background, and then we look at the consumer financial needs and challenges, and then look at the use cases in terms of how do they meet those needs or cope against the challenges. And lastly, we'll look at the impact of financial inclusion, financial health and well-being, and then the discussion, key takeaways. So let's then do that by looking at the research objectives. The research objectives provide a framework for designing the methodology, analyzing results, and evaluating the success of the research. Now, having said that, we have grouped it into twofold. And centered around two critical areas, which is comprehensive financial landscape assessment through understanding and monitoring the current state of financial services in South Africa, analyzing the progress of people's financial needs and behaviors, and evaluating the sector's effectiveness in meeting those needs or coping against the challenges. And then secondly, driving evidence-based action for impact through leveraging the insights gained from the landscape assessment to inform and enhance financial inclusion initiatives. Maybe quickly, we do have two types of FinScope surveys. And I think Nonto and BP, they've covered a lot about the FinScope Consumer, which has been implemented in around 38 countries and enable the regional cross-country comparison. We do also have FinScope MSME, and it has been implemented in around 8 countries, providing a comprehensive focus on individual entrepreneurs and owners of micro, small, and medium-sized enterprises, along with their financial needs. So I'm not going to talk about the fact that it's conducted annually, the consumer, but the MSME, we do it, so if I'm correct, every after 4 years. And also it's being funded by the initiative of both public and private sector. Now, moving to the methodology, maybe let's just paint a picture for our international guests. According to Stats SA, the estimated mid-year population of South Africa for 2024 was 63 million. And for this report, we are talking to 45 million adult population, defined as 16 years and older. 23 million of them being female, that is 52%, including approximately 3 million international migrants, and a large proportion of adults reside in Gauteng province, which is this one. Now, looking at the design itself, the sample is representative at the national, provincial, and urban and rural areas. We interviewed a total of 5,600 people, including a booster sample of 600 interviews to ensure representation of foreign nationals. There was a mention that, no, we started in 2003. So in 2002, we piloted the FinScope, and the sample size was around 2,000. Then when we implemented the first national survey, the sample size was around 3,000. And so we have been increasing it, adapting to the sector needs. Now we're sitting at 5,600. The interviews were conducted in respondents' homes between August and October 2024. The collected data was weighted using 2024 mid-year population estimates to accurately reflect the demographic distribution. Now, as stated in the objective, the main purpose of this survey is to understand and track the levels and drivers of financial inclusion. And this section deals with that. Let's see where we are. Let's get the picture. Formal financial inclusion is high among adults, South Africans, reaching 98%. If you bring those who are relying on informal only, it will be then 99%. Notable 70% use a combination of formal and informal financial services, perhaps to bridge gaps in informal services or to meet specific needs and circumstances. Now, what drives the product services? bank accounts. The bank population includes the 22 million or 48% adults who receive social grants, including child grants, SDR pension, among others, through their bank accounts. And then secondly, at 74% is a credit uptake. Access to credit is high, driven by the needs to address basic needs and aspiration. Then you've got remittances sitting at 63%, which includes those who are sending money or receiving money domestically and cross-border remittances. Then we've got insurance, mainly driven by funeral cover due to the high cost of funerals. We'll deal with that later on the insurance section. Then we've got savings. Almost 50% of South Africans are saving. 37% have formal financial services and 32% informal mechanism. When you look at the gender differences in financial inclusion, women lead in the uptake of bank accounts, mainly due to access to social grants, particular child grants. Women also show high uptake of funeral cover, credit, and savings compared to their male counterpart, which is often linked to their participation in the informal financial sources. Now, let's just summarize the financial inclusion journey and also maybe touch a bit on the elements of financial inclusion 2.0. With the overall adult population growth expanded at a moderate rate, the financial inclusion increased significantly within 2 decades. But food security, as you can see there, has slightly worsened, especially between 2014 and 2024. The number of adults borrowing for food has exploded in the same period. What are the likely implications? The swift rise in financial inclusion and borrowing for essentials reflect both notable progress in expanding access to credit, the formal credit, but also underlying economic challenges. Now, the quick questions to keep in mind for the upcoming discussions. Why is this so? What does it tell us about the financial inclusion and the well-being? How can we better understand what underpins these changes? So let's just bear those 3 questions as we move forward. Now, speaking of economic challenges as the probable link in terms of sharp increase in borrowing for essentials and the transactional accounts used mainly for receiving social welfare, let us explore the socio-economic context of 2024 to better understand what drives financial inclusion. 50% of adults do not have matric qualification, which have significant consequences for broader socio-economic conditions, including limited formal job opportunities, as you can see there, and the impact on economic mobility, which includes the income disparity, but also dependence on informal sector. And thirdly, increase unemployment rates. And when you speak of unemployment rates and look into the profile, 61% of the unemployed are women and 54% are youth. Now, we touched a bit on the informal sector, which is kind of growing. Maybe let us just paint a picture before we could go to the 4th economic condition. In 2024, approximately 8.2 million people worked in the informal sector, representing a decrease of around 300,000 compared to 2023. This is 46% of the total employment. The informal sector mainly employs South African born males at 86%. And it's skews towards male, and then slightly higher amongst the youth. So when you look at the gender gap, the significant gender gap highlights disparities within this sector. The high reliance on informal work among youth underscores difficulties in accessing formal employment. However, this also presents an opportunity to absorb more youth into the informal sector as a way to reduce youth unemployment. The average income for informal employed workers in South Africa is 4,600. And you can see there we've got the equivalent of 256 USD. However, half of these workers earn 3,000 or less, which shows that the sector has some inequalities which we need to look into when we are busy supporting the sector. Another information on informal sector, we tried to compare it with other peer countries. The sector in South Africa is relatively small. When you look at the countries such as India, Mexico, and Nigeria, it appears though more comparable to Brazil and perhaps Turkey, although these countries tend to have lower unemployment rates. With the relevant support, the informal sector will go a long way in creating sustainable livelihoods and reducing levels of unemployment. The sector is driven largely by domestic and personal services and construction, maintenance, and manual labor, both categories totaling to 70%. Now let's look at the fourth economic conditions, which are the low levels of household incomes. A substantial portion of adults' population, that's around 32 million, lives in households where the total income for an entire year is less than 140,000. This figure has two critical implications. Firstly, an annual household income below 140,000 often places these households below poverty or low income threshold, meaning they struggle to afford basic necessities such as food, shelter, healthcare, and education. Secondly, within this group, around 7 million adults live on as little as 1.67 USD per person per day. And the profile of this segment is mostly women at 75%, and youth 74%, and those who are receiving money, income, or livelihoods from social grant recipients and informal employees, 83 and 74% respectively. Now, lastly, the fifth economic condition is dependency society. Close to 60% adults mainly depend on state grants and money from other people for their basic needs. In such societies, dependence on external support often results in limited self-sufficiency, reduced economic participation, and challenges to sustainable development. So these are the realities. Now, having painted the picture of the socio-economic context in 2024, let's try to understand the consumer needs, which are significantly shaped by the socio-economic struggles, which can influence their financial behaviors, preferences, and types of products and services they seek. The fin needs has 4 dimensions, including how they transfer money or how they access money, which is called the transfer of value, the ability to manage income and expenses, which is liquidity, and also checking how resilient they are towards financial shocks. And then lastly, do they have goals? If they do, how are they meeting those aspirations? Now, speaking of transfer of value dimension, it focuses on the process of making and receiving payments. As you can see then, 87% of individuals receive income and grants through digital channels. However, if we look again at the informal sector, 65% of the 8.2 million employees in the informal sector receive income in cash. Among those receiving money digitally, 90% withdraw cash monthly, and 97% of the population use cash for payments. And then only 54% of the population use digital platforms or online channels to make third-party payments. Now, adults in South Africa allocate money monthly for the purchase of food and or groceries, and 97% of them use cash to buy food. And approximately 2/3 prefer to pay food or groceries with cash. And cash is preferred over digital payments due to its ease of use and convenience. Very few adults cited safety and security as reason for their preference, indicating that concerns over digital security may not be a main barrier. In fact, those who prefer digital payments ranked this attribute highest. Therefore, the focus should be on improving digital literacy, trust, accessibility, and infrastructure. The second dimension is liquidity and what is the status. And we have said, no, this is, we are looking at how people are managing their income versus their expenses. Most South Africans struggle with managing income and expenses. Managing income and expenses is challenging for adults who receive social grants and income from informal sector. And we'll keep on highlighting this because we are appealing to the sector to say, how can we support the informal sector, which employs around 8.2 million, which is 46% of the total workforce. Income from grants, especially child grants and SDR, is limited. Earnings from the informal sector are often irregular and unpredictable, making it hard to plan and budget. Hence, they are the most vulnerable groups when it comes to liquidity. Thirdly, we're looking at how people are coping with resilience. More adults experience unexpected financial losses due to unforeseen events. This is up from 45% in 2023. And the top three eventualities include funeral costs. Funeral costs pose a substantial unexpected financial burden, mainly driven by the high expenses associated with funerals in South Africa, which are often influenced by emotional and social pressures. And then secondly, it's the job market fluctuation. Adults experienced layoffs or their businesses closing down, resulting in unexpected financial losses. And then thirdly, we are having health emergencies. And without adequate health insurance or savings, individuals may struggle to cover medical expenses, impacting their financial stability. Now, the fourth one, which is meeting goals in the Fin needs. By connecting aspirations with financial services, we can better understand how financial tools and support can help individuals realize their ambitions. Key top aspirations in our country include housing and land. Building, buying a house to live in or to move to a better apartment is sitting at 83% or around 15 million of adults. And around 7% they will want to make a renovation in their current homes where they are staying, and then 4% they want to buy land. Then secondly, is the investing in the current business or start a new business. This is 15% of adult population, which is around 7 million. And then lastly, education sitting at 8%. This figure may look low. However, in South Africa, we've got quite a number of people who are attending the non-paying schools, and also in your tertiary level, there's a huge program of supporting the students that are coming from the low-income groups. Now we've painted also the needs and the challenges that the South Africans are facing. Let's now check how are they coping and which strategies they are using in the next 2-3 slides. It appears that people often rely on alternative coping strategies beyond financial services to address their challenges and pursue their aspirations. So if you check them, only 51% of individuals utilize financial tools to manage financial shocks, although 26% relied on informal mechanisms. While 57% has specific life goals or aspirations, many are relying on non-financial methods or lack strategies to achieve these objectives. Please note, the non-financial devices include those who are working overtime or doing extra job to get money and to meet their aspirations, or they simply adjust the budget, or they sell the asset and rely on social support. Now, just looking at the climate change related risks and what coping mechanisms are they using. The proportion of adults experiencing climate change related risk increased from 42% in 2023 to 53% in 2024. And 21% of adults in South Africa experience recurring risk related to climate change. And the South Africans will know that, will testify to that no, we just now, beginning of May, late April, we're experiencing some floods in KZN. Most South Africa face unexpected weather-related challenges, such as floods and drought, each affecting 29% of the population. Provinces with highest prevalence of heavy rains and floods were Eastern Cape at 42% and KZN at 41%. The Western Cape followed closely behind with 39%. Almost 40% would seek government assistance or ask for donation from community to cope with these eventualities should it happen next year. And only 24% would use the financial risk products. Just keep on, I would like you to underline this 24% because there is a pattern as we are moving forward. Now, understanding the relationship between socio-economic factors, consumers' needs, and financial product or services used is essential for creating effective financial services that truly save diverse population. So let's look at the makes and the shift in terms of the uptakes in the next section. So starting with the banking sector. Now, 41% of banked adults have inactive accounts that are mainly used only to receive income. And we call those, we have labeled them as a mailbox because they will receive the income and then they will withdraw everything at once. Now I spoke about the 24% figure, you can see there. Only 24% of the banked adult population actively engaging with their banking accounts, conducting transaction 3 or more times monthly. Now another 36% exhibit limited usage, transacting less than 3 times per month. This reveals several important implications for the banking sector, highlighting both opportunities and challenges. There is an emerging trend of maintaining multiple bank accounts. As you can see there, highlighted, 57% of the bank population holds multiple bank accounts across different providers. What implication does this have to both the financial sector and the consumers? I'm sure we'll be debating that later on. The further data disaggregation indicates that vulnerable groups are more likely to hold multiple bank accounts, likely to facilitate the receipt of grants on other hands, and deposit from other income sources. Typically, SASSA cards are designed for government benefits disbursements only, and are not intended for other types of deposit by a third party. And I'm sure in FinScope 2025 we'll dig more into this. But also you will see that now in your green font there, the multiple bank accounts, it's not only with the vulnerable groups, but you can see there that now the wealthy people from the wealthy cities and the affluent and so forth, they also have multiple bank accounts. Half of the bank population experienced banking challenges in 2024. This is up from 41% in 2023. 23% were fees and charges related problems. Of those who experienced banking challenges, about 2/3 informed their banks, and about 30% did not report the problem. A question, what implication does this have for responsible finance? Now, we said no, the second driver in terms of financial inclusion or uptake, it's access to credit. So let's just check in terms of the mix. 63% or 27 million adults, South Africans, are credit active consumers, mainly through formal channels. This is a positive sign for financial inclusion in terms of access to formal credit sources, showing an increase of 2 percentage points since 2023. However, then when you look at the usage, and we indicated earlier that no, it's mainly driven by your basic needs. A significant proportion, that is 37%, or 16 million, utilize a mix of formal and informal credit. This could imply that formal credit alone is not sufficient to meet their needs, or that informal sources offer advantages like the speed, accessibility, or less stringent requirements that complement formal options. Another distinct group of 11% of consumers, that is around 5 million, relies exclusively on informal credit mechanism. This highlights a significant segment of the population that is either unable to access formal credit mechanism. This highlights a significant segment, as I've said. So this group may face higher interest rate and also less favorable terms and lack of consumer protection offered by formal institutions. This is a key area of focus, I think, for financial inclusion efforts moving forward. Furthermore, a notable number of people engage in borrowing from their personal networks, including family relatives and of friends. So of this number, I think 12% exclusively borrow from friends and family. And if you add that to the 74%, you will then have 84% of credit active consumers in South Africa. Now, I think the last slide on the credit, it's rather concerning. 75% of adults who borrowed money in the past 12 months use it for essentials, including borrowing to buy food, representing a 3 percentage point increase to 43%. And then FinScope 2024 also shows that 10.4 million individuals were over indebtedness. This is 37% of those borrowing from formal credit source. If you include the 5 million that exclusively borrow from informal, this figure rises to 12 million of those who are struggling with their debt. Quickly on the remittances, 41% of adults send money to someone who does not live with them, an increase from 37% in 2023. This figure includes 39% of people who send domestic remittances within South Africa, recording 6 percentage point increase. You can see there the use of banking channels for domestic money transfers has risen to 73%, largely to the sector innovations like wallet money platforms. The same story here in terms of those who are receiving remittances, it increased. And what we are seeing there, most of the recipients are predominantly include vulnerable groups such as those who reside in the townships and rural areas, youth and women. Now, we did speak about insurance and said no, around 60% of adult South Africans have some form of coverage against potential eventualities. A figure that has risen from 53% in 2023 to 57% in 2024. However, this coverage is mainly driven by funeral insurance. This is understandable given the funeral costs are significant concern for most adults. Meanwhile, the non-funeral funeral financial product continue to face challenges in attracting non-formal employees. The expansion of non-funeral insurance in South Africa is hindered by unemployment and little irregular incomes, while funeral insurance is regarded as the most important type of insurance. Now, looking at the savings, more people were saving in 2024 compared to the previous year. However, the uptake was driven by informal savings, and reasons for savings show that people want to address basic needs and aspirations, including 38% adults who put aside money to ensure they have funds for basic essentials such as food and clothing. Additional 11% save for funeral costs and medical expenses. Meanwhile, 24% save money with aim to achieve future aspirations, including education, starting business, housing, and preserving family legacy. And again, I said, no, please note this 24%. And it's very consistent. I think it's more in line with the 21% of those who are formally employed. Now, this is the last section, going back now to the journey of financial inclusion, which we have painted earlier on, and trying to understand if it does have the direct impact or consequences in the financial well-being of the individuals. The financial health, we are using the financial health indicator, which aligns with the UNSGA DORA frameworks. Please do download the PDF version of this report. It includes the composite financial health scores, which is normalized and measured on a 100-point scale for ease of interpretation of the data. South Africans demonstrate high levels of financial inclusion among adults, as shown in the previous sections. However, this does not translate to an improving financial health landscape. Although the proportion of financial vulnerable adults decreased from 33%, just check at your red bars there, decreased from 33% to 28% in 2024. There was a notable decline in the number of adults considered financially healthy. And now these 24% of people, they got already, and their financial status dropped, and now they are just simply coping. Collectively, the financial situation of 70% of adult South Africans either remained unchanged at 39% or deteriorated, that is 31%. The fact that 70% of adults saw no improvement or a decline in their financial situation indicates that underlying economic or systematic factors are hindering the progress. The distinction between high level of financial inclusion and the relatively low number of financially healthy individuals is driven by several factors. Many people are only partial covered, with most funds allocated to funeral cover, often neglecting other risks such as climate change-related issues. The low incomes also pose liquidity challenges, leading individuals to prioritize savings and credit for meeting essential needs rather than capitalizing on economic opportunities. Among those striving to achieve aspirations, the majority rely on informal mechanisms and non-financial methods as painted earlier on. Now, if we quickly look at overview of the financial vulnerable population, it shows that they are mostly those without formal education, at 54%, with low financial literacy, and including unemployment individuals, low income groups, residents of rural areas, and women. So financial well-being for individuals, and this can be said for the business as well, depends on many things besides financial services, like income, living costs, financial knowledge, and education. Now, relying only on financial services isn't enough to improve their situation. To help vulnerable groups, we also need good jobs, education, infrastructure, and stability. Without these efforts to include more people in the financial services, we'll have limited results. And I think this is what Financial Inclusion 2.0 is all about. Now, in conclusion, South Africans are economically stressed, a situation that has not improved over the last year. The data reveals a complex picture where high financial inclusion does not automatically translate to financial well-being. For both regulators, policymakers, and FSPs, the focus needs to shift towards understanding the underlying socio-economic realities, addressing systemic barriers, and designing and delivering financial products and services that contribute to create value, especially for the vulnerable groups. And lastly, building financial ecosystem that genuinely support the financial health and resilience of all South Africans, particularly the vulnerable group. Ladies and gentlemen, thank you so much for your attention.
What I was impressed with is the level of penetration for non-life insurance, because I've been in the industry for more than 25 years, so we've always gauged it around 4%. So through your research, we are now able to say it's sitting at 22% for 2024. So that gives us some kind of comfort in terms of we are doing something right in terms of trying to get the products to the ultimate consumers.
Yes, sir.
So what stood out for me was the consistent 24% that Jabu pointed out. And I think for me, it highlights the fact that financial services on their own don't necessarily address the structural issues that we have in the country, and we really need to think carefully about what is financial inclusion without other elements. So we can't really work on our own. We can't expect the authorities that focus on financial inclusion to work on their own. They need to collaborate, and I think it's something that Nontobeko highlighted, that individually you're not going to be able to do it, but you need to coordinate. But I think the coordination, ever since I've been in this space, has always been the financial sector coordinating. But I think we forget that there are other elements that we need to consider. And for me, that's the takeaway that I took from this data.
Thanks. Taba?
For me, it was the confirmation of the numbers that we already know. and we are not so happy about. Well, we are happy that 86% has bank accounts, but what's the point of having a bank account if it's just a mailbox? So it is a confirmation of the information that we know, which means then there's still a lot that we need to do as a country and as an industry to ensure that we get it beyond just people having bank accounts to it being useful to people to have a bank account. I know, for instance, if you're a SASSA recipient, you won't get anything if you don't have a bank account. And that's why some of the numbers are high. But in terms of the usage, it is still something that we need to strive harder as an industry and as a country. Thanks.
Sure. Thanks. The thing that jumps out at me every time is the number of people that borrow money to buy food every month. It's an astounding number and it's going up. So I think we're sitting with a serious food security problem here. But Tabang, the other one that jumped out of me is 57% of 57% of South African adults have more than one bank account. Some of them more than two. Now, we always hear bank accounts are expensive. It's a grudge purchase, as you say. You can't get a grant or get paid a salary unless you've got a bank account. So you didn't choose it, you were forced to take it. But then so many people have more than one account. What's going on here? How does the banking sector make sense of this? And what are the implications for the banking sector?
Yeah. It is an interesting phenomenon because what happens in South Africa is South Africans search for benefits. So if a bank account comes with certain benefits, we'll get it to get that benefit. And we forget that there are bank charges that are lined up to that. So you'd find more people having more than one bank account. One is also the issue of trust in the system as well. People tend to not have so much trust in one bank, and if they can also be able to access loans, it is easier to negotiate loans from different bank accounts than just from your own alone. The implication, of course, is it costs the banking sector a lot more to, one, onboard the clients, two, also in terms of regulation, to FICA and RICA and all sorts of cars that have to happen in South Africa to get you a bank account. It costs the banks more. And of course it does cost the client. But I don't think South Africans look at it from that cost point of view. They look at it from a benefit point of view. Give you an example, not to punt a bank, because I may just get charged for favoring one. But there's a particular bank that gives you a lot of freebies if you do certain things. And so if you want, for instance, to have a fast exit or coming into the country at the airport, you go and get that particular bank account. Just because you have it, there's a special lane for you. So it's those kinds of things that sometimes motivate people to do.
Sure. No, thank you. I wondered whether the competition between banks has driven this up. As you say, the freebies, the promotions, all of those things. But on the other hand, from an RFF point of view, is that you're dealing with wily consumers who are managing their creditors. You have one, they give one account. If they need to pay, they get someone not to pay them in that account because it will be swallowed. There's an overdraft there. Give them another account. I think in next year's FinScope we will dig more deeper because it is a trend that's going up. Pamela, I want to come back to you. Maybe if you can share some of the innovations in the sector, in the insurance sector, around spreading more non-funeral insurance, and what are your challenges around doing that? Regulatory policy and any of the issues that you're grappling with, and importantly, what are the innovations that the sector is thinking about?
Non-life is very competitive, so they compete on product, they compete on price. So there are a lot of players in that space, right? So that drives innovation, right? But the only conundrum is affordability, especially for the vulnerable parts of our society. So we as SAIA, we have made a couple of proposals to the government in terms of, from a PPP perspective, to reduce that protection gap. Now, the innovation part, which is a product that was released last year, it's a parametric solution, which means it's cheaper than your traditional insurance. It can cover a geographic or a spatial area. We've tested it from an emerging farmer perspective in partnership with our regulators. It's now being allowed to be underwritten. But for now, it's only for weather-related events. So that kind of spatial cover, whether the person on the borderline in that spatial area has suffered a loss or not, from a basis risk perspective, they might actually get a payout without actually suffering a loss. So the kind of cover you would have would be like your flooding and drought type of covers, which is, as I saw from the stats, that those are the typical type of weather-related events that people are suffering from. And with that, we are trying to pilot with the Agri Department specifically, but the way we have proposed it to the government, it's not just for Agri. It can be used anyway. And it's seen from other jurisdictions that it's a good solution to go into an emerging space. So an emerging space would be, it's underserved at the moment, meaning the products that we have now are still deemed to be unaffordable to those that are in that space. So this is a big milestone win for the industry. And I'm hoping for much more, what we can do with this particular solution.
Sure. Any thinking about the informal sector?
The informal sector is where your emerging space is, where your underserved space is. So if you can reach them with a product offering that is good enough, but it's not your Rolls-Royce type of cover, meaning they can financially recover after a loss, that is good. For instance, some index, like for farmers specifically, I know this more robustly because we did the proposal, is that farmers have seed, fertilizer, diesel. You can have that kind of cover. Should they lose that before they even get to harvest, that kind of cover can be given to them. And as you know, they go to your financing facilities in that space. So the way we have arranged that kind of cover is you group them, so it's not an individual type of setup. And with individual type of setups, that's where insurance gets expensive. So if you aggregate it through one portal of aggregation, you're able to get to many beneficiaries. And that kind of, it's a different approach to your typical indemnity type of insurance, your traditional type of insurance. And that's the kind of innovation from a trade association and industry perspective we are driving versus, in addition to insurers doing what they do normally, which is compete on the products that they're offering currently.
Thank you. For those who don't know the South African sector, you've seen the insurance numbers there. It says about 60% of South Africans are insured. More than 50% of that is funeral insurance. South Africans spend around 15 billion rand on insurance every year. So that it's unique on the African continent. Average spend is about 40,000 rand per funeral. Sorry to get a bit morbid here, but that's an enormous amount of money that's taken away from other insurance that may be more valuable, or investment in education, etc. I think South Africa and Lesotho, one of our neighbors, are the only two countries where we see this happening. And this is people taking funeral insurance, and of course the insurance industry is making a killing of it. When someone dies, they cash in the insurance. They also save in the informal sector, insurance savings groups, as well as going to debt. And this is something that for me, is one of the biggest bugbears. If you could spend half of that money on something else, I think we would be doing well. Lesego, this challenge that we have of bridging financial inclusion and improving people's livelihoods, or improving the usefulness of the products that people have. What are some of the things that you think we need to be doing or are doing in South Africa to do that.
So maybe the start is what we're doing here, right? The FinScope, because it helps you understand those people that you're trying to include. But I think a key thing that you also need to understand is the numbers are at a surface and there's more to the people that have been surveyed. And you need to go and have conversations with them. So I was listening to Dr. Chilwane when he said, no, they're just looking for cost. They're looking for an advantage, a product that fits them. And I think it's because we don't necessarily have the required conversations with these people that we're trying to include. But also, when we look at these numbers, we don't think, could there be a financial literacy issue here? Could there be something that the sector needs to address? And that, for me, are the things that we need to think about. And some of the initiatives, I think, that are on the ground currently that start addressing some of those things, and I think it goes back to what Nontobeko mentioned, is making sure that when you come together and you say, I'm going to put together a financial literacy or a financial inclusion strategy, you're not doing it in isolation. You do it in coordination. But I think, to my colleagues, because we all work on this, what we didn't have sight of is that we probably needed to get the Department of Labor and the Department of Social Development and everyone else in that room, so that when we craft that financial inclusion strategy, we're not crafting it in isolation, but we're crafting it understanding that actually the sector is trying as much as they can do, and they're only able to capture the 24% that we're seeing, and that's because they're employed. Naturally, the rest are going to struggle. So imagine I get 450 and I know that from a grant, and I also know that my money may disappear, which is a perception. My money may disappear if I don't have, if I keep the money in that account, and Dr. Chilwane, I'll then have an alternative account so that my money does not disappear from that account that I got from SASSA. And that, to me, it means that, but I'm also trying to manage. And then I know that when I try and make payments in my community, I'm going to be charged an extra 10 rand. And this is lived reality in South Africa, or an extra 10% for every transaction that I make. Not because then I'm going to manage my money and I'm going to withdraw all of it. So I think some of the initiatives, like the community digitization project that we're implementing in collaboration with the World Bank, SECO, as well as the South African Reserve Bank, are some of the initiatives that start making us think beyond financial inclusion, but rather think about the person that you're saying, I want this person to have financial services and products. And then understanding that what are their needs, and then making solutions and thinking about a product that serves them and not a product that we think will serve them from a boardroom. A financial literacy program that they understand, and not the one that we sit in this room and craft and say it's going to work. So I think thinking about things that way, Brandon, for me, is what we need to think about, but also thinking about the entire value chain and saying, if Lesego is a grant recipient and Lesego only earns 450, I honestly cannot expect Pamela to include her, because what is she going to include? Because she needs this money to eat. So then you think about what other programs are there in the country that can actually get Lesego from not earning 450 anymore to actually having sufficient income, that they then move the 24% to 30% to 50%. So I think for me, it's thinking about it that way and thinking about what opportunities are there in the country and how do we collaborate and coordinate and ensure that these resources that we have in the country start providing opportunities for people that actually need them. We know, I think we've done a bit of assessments in our Generating Better Livelihoods project to try and understand if they are, and they exist. I think it goes back again to lack of coordination and us making sure that we pull the resources that we have. And it's not only in South Africa, in different countries in the world, that you pull your resources together to understand that it's not only financial inclusion that's going to have an impact, but it's a combination of things that need to have an impact.
Great, thank you. Ladies and gentlemen, I think we've depressed you enough for one evening. It's not time to slit our wrists yet. I think the progress that we've made in South Africa and elsewhere by including more people in the financial sector was an important first step. We need to take the next step to make it meaningful. And that's really what our challenge is going forward. So, and one of the important things is we should stop singing to the choir. What is it? Preaching to the choir. There are other players that need to come and work with us so that financial inclusion is not seen as a panacea of all evils. I think if we present it in that way, it's going to fail. But it does mean we need to work differently going forward. So thank you very much to our panel. Sorry for rushing you. Thank you very much. As I say, the colleagues from the FinScope team and other members of the FinMark team are around. Please get to them, ask them questions, and engage with us on this data. We're quite open to do it whenever you want to. Thank you very much. RFF, now the official cocktail is commencing at the lawns outside near the bar. Jayashree? Beyond the bistro, outside of the bar. I think you'll see a nice setup there. Please can we proceed there so that that part of the evening can commence. Thank you very much for joining us.